Hi, today I'm taking a closer look at iRobot, the company that brought us the Roomba Robot Vacuum back in 2002. And since then, the company has sold over 30 million robots, and we all know the products. It is likely that you have, or someone you know has, a robot vacuum cleaner. And today I plan to see whether iRobot has a good enough competitive advantage to stay ahead of the competition for the long term. For those of you who are new to my channel, well, welcome aboard. I'm going to analyze the company iRobot today by looking at the industry they are in, the competitive forces they face, the management team running the business, my evaluation, and then my opinion. Now, if you don't know some of the terminology that I use, look, don't worry at all, just sit back and follow along as best you can. Look, it's part art and part science anyway. And I'm trying to help as many people as possible understand what they're actually investing in, because most people spend more time researching their next phone than they do their next investment. Now, if you have a stock you would like me to cover, please make sure to tell me some real reasons why it is a potential 100 bagger. So that's a stock that can go up 100 times over the next few decades. So it will most likely need to be under $1 billion in size right now. Firstly, iRobot started the entire industry. This would have been an incredible ride as the founder of the company to build an invention, really, that never existed before and grow into a multi-billion-dollar company. Anyway, we can't start investing in the company in the early days. We have to see what is happening today and into the future. And the big question I have is, how long-lasting is this industry? Well, logically, we all have floors in our houses and we don't like messy floors. So I do think robot vacuum cleaners are the future. If we look at these two pie charts, you can see over the past 8 or so years, the market has more than doubled in size. And if we look at the right-hand side, we see that there are a lot of addressable households just in the US, and there is only about 13% of these with a robot vacuum in them. Then we can think about Europe, Japan, the Middle East, and the addressable market is big. Now, regarding innovation, I do like their newer higher-end products that self-dispose of the dirt and the dust. When the robot goes back to home, it unloads into a bigger bag at home base so it can do a couple of months of cleans before needing a human to touch anything. Plus, you can see how it is going on your phone. Consumer robots is a cool category to be involved in, and I think there are other things in the house that could be robotized. iRobot are working on lawn mowers as another addressable market. Now, I do prefer companies with smaller market caps, and at $3.8 billion market cap, I guess that's still pretty small. They are doing the best they can to innovate in the space, which is exactly what is necessary as tech moves fast, and competition in tech, as we know, is incredibly difficult. Now, when we look at the market share, iRobot are all the green sections of these pie charts. So they are clearly the dominant robot vacuum cleaner even 18 years after they started the industry. They are losing market share outside of Japan and the US. So competition is an issue. They do hold a lot of patents though, over 1,500 of them in the US. Now, they are currently in legal disputes against their major competitors of patent infringements, but this is a tough, expensive battle. Generally, Chinese manufacturers have been able to take market share in smaller countries where iRobot just can't defend those patents. This is such a typical issue for inventors, and it sucks. There are plenty of cheaper alternatives in the market, and this will only get more and more fierce. Look, innovation is great, but competitors are always going to catch up. And at the moment, unfortunately, I don't see anything amazingly special about iRobot. So competition being fierce and able to undercut iRobot, well, this is the first red flag for me. But turning to some of the financial metrics, gross margins have been solid for a long time, between 40 and 50%, which is really good for a hardware company. And this is book value per share, and it looks perfect. So although the competitive landscape is unclear in the future, iRobot have been able to do a wonderful job at growing the business and keeping dominance in the industry that they created. But I can only give them a half tick here, as competitive forces of the future are just too hard to predict. Colin Angle is the founder and CEO of iRobot. Now, I really like owner-operators, as that is a common trait of companies that can go up 100x. Now, he owns 36,000 shares, which is about $37 million worth. His compensation is about $6 million, which is high for a founder and doesn't have the big stake in the company that I'm used to seeing from founders. But still, his net worth is tied to the performance of iRobot, so that is a good thing. Regarding debt, iRobot has practically no debt. So that is perfect, just what I like to see. Now, return on invested capital, or ROIC, is one of the most important metrics of a 100 bagger as well. It is how much money the company makes on its investments into the business. It is a sign of compounding, which means the business each year makes money, invests that into the business, and then makes even more money the next year. So anything above 15% is good, and the higher this number, the better. So how impressive are these ROIC percentages over the past 5 years? Not only stable, but consistently above 15%. This is a good compounder, something that gets me very interested. Okay, now price is super important because the lower the price, the more upside potential we have, plus the less risk we take. I like minimizing my risk, so the best way to do that is to pay a price just lower than fair value. Okay, now I use this table as a bit of a guide. I made this. So the price to free cash flow is the relationship between the stock price and how much free cash flow the company is making. I then factor in the growth rates to get a target price to free cash flow number. Look, this is a very rough way to value a company, but it is pretty good to get a ballpark figure, and then I compare that with my discounted cash flow method. Now, looking at future growth rates is where things get really difficult. Predicting the future is just impossible. Yahoo analysts think 18% growth per annum over the next 5 years, and Zacks analysts think 15% per annum. But look, no analyst could have predicted what happened in 2020. So who knows what is going to happen in the next 5 years. So my theory at the moment to help me calculate this is to assume that 2020 was an abnormal year, and the growth from say 2015 to 2019 is probably more in line with what will happen moving forward, which was about 20%. That feels pretty realistic to me, so I'm happy to go with the analysts and let's be conservative and call it 15%. Now the current price to free cash flow for iRobot is 17. So the stock price is actually not too overpriced. A 15% growth rate should be somewhere between 10 and 25 on the price to free cash flow table. So this is right in the right range. Now, if I look at my fair value calculator, which factors in more information, and if you want a copy of this, it's free and it's in the description. Now, I'm going to use 15% as my estimated growth rates here. My return on investment goal is normally about 15%. Well, that's what I'm going for, but I push for 20%, so that includes a margin of safety. I'd actually feel more comfortable at 22%. The historical average PE is about 20. So that's what we should get in the future. That is what the multiple is. Now, what I have done here in this discounted cash flow is use the current free cash flow number. Now, the problem with this is that free cash flow is lumpy. 225 million would be twice as much as normal. Sure, maybe this is the start of a great free cash flows, but it is most likely it will return to a more normal number, like 100. So $150 would be an okay price if the free cash flow was sustainable. But I don't think it is reliable. So I have moved it down to a more average number that I think is more indicative of the real situation. So now, after making that change, I get about $75. Now, considering that I am worried about the competition in the future, and a lot of things could potentially happen in the tech world, I actually want a bigger margin of safety. So now I'm aiming for 22% return on investment. 22% per year would be a great return. To get that, I think I need a price under $65. If I go and take a look at the stock price, well, it looks as though only a couple of months ago, back in November, it was $70. But now it has pretty much doubled since then. Based on my discounted cash flow, I would say the stock price is now at about fair value, and I think we've missed this one. Okay, so the negatives are, the patents are hard to protect, and I don't think the patents are strong enough to withstand innovation in the space from others. Now, the competition advantage they have is just not clear, and no super investor that I follow have invested in this company. But the positives are many. They have great historical growth, they have good compounding metrics, no debt at all, and a pretty small market cap. Financially, they are a really good company, and all the metrics look good. And the only reason I feel uncomfortable is that I just hate unclear competitive advantages. Maybe if the price becomes silly low again, like under $65 like it was a year ago, that would be tempting. Now, don't forget to subscribe so you don't miss my future videos. Hit me up in the comments if you have an opinion about iRobot or maybe another proven company that has big upside potential. And obviously, you will need to investigate a lot further if you want to invest yourself, but this hopefully has got you started. Thanks for staying to the end, and I'll see you in the next video.